To begin, let me introduce Christine Lee, our speaker today. Christine is the Asia Pacific Head of Research at Knight Frank, a highly respected real estate thought leader in the region with more than 15 years of industry experience. Most recently, she was Head of Business Development Services for Southeast Asia. She was responsible for real estate and economic research, strategic analysis, and providing research-based perspectives for commercial leasing and investment. Christine began her real estate career as a property correspondent and commentator with the Singapore Press Holdings, where she had access to key market players, including listed companies' CEOs and government officials. She is extremely bright. She has an engineering degree from the Ivy League from Cornell University and a master's degree in media and communications from the University of London. Welcome, Christine, and over to you.
Thank you, Rick. Thank you, everyone. I'm very happy to be here sharing with you the latest Asia Pacific research report on asset repurposing and its implications on real estate investments. So although real estate has always been touted as a stable and attractive asset class, I think the COVID pandemic has actually exposed the weaknesses of this asset class, given the disruptions of income as a result of the lockdowns and also the travel curbs. And many older assets are underperforming right now. And that's when your asset owners are actually anxious on what to do next with these assets. So for the next 15 to 20 minutes or so, let me just go over some of the key considerations investors have and also the demand drivers for asset repurposing. And first, let's take a look at some of the investor considerations. Next. As you can see, as a result of the pandemic, some of the older assets are increasingly being shunned by investors as well as occupiers. And it's very clear from this chart, which we pulled from RCA, Real Capital Analytics. And you can see that when O isn't go, this is the age profile of the assets transacted across Asia Pacific. And you can see that the end result, especially in 2020, the volume has actually been gravitating towards better and younger assets because there is a decline of 27% in the transaction volume of the older assets more than 20 years old as compared to a milder 7% decline in the younger assets. So it's clear that better quality and more prime assets actually across all asset classes have continued to hold up, but the B grade and also the mature assets are fast becoming obsolete. Next. So despite the travel curbs and the lockdowns, investment sales actually took off really well. And in 2021, you can see that it's a rebound somewhere to the level of 2018 if we count the fourth quarter, and just a tad lower than 2019. And if you see that China stood out quite strongly in 2021 as it saw a lot of transactions changing hands, it has also taken over Japan to be the biggest real estate investment hotspot in Asia Pacific, where 30% of the transactions actually took place from China. And Australia has also remained a top choice for capital throughout this pandemic, a safe haven market, just like Singapore. It has attracted a lot of the European capitals driven by very low interest rates. And we are also seeing some pickup in South Korea, particularly in the office assets. Next. We have also launched this global capital markets research paper called Active Capital, which you saw in the video just now. This is a prediction of the trends in the investment world in 2022, and it has a wealth of intelligence around cross-border trends. And here's some very high-level summary of what we see in the predictions. So globally, you can see that cross-border capital is expected to reach a record high in 2022, with the opening of these travel borders as well as the availability of the assets and also capital ready to be deployed. So really the flavor of the asset class continues to be office, which will take up about 50% of the transaction volume in 2022. And the top destinations are still going to be mostly around the US and the European countries like the UK, Germany, France, and Netherlands. And hospitality assets are coming back strongly in 2022, particularly amongst the private equity investors. And there is also more emphasis on the ESG factors. There is the environmental, social, and governance, which we are seeing a premium of 8 to 18% in transaction prices based on our proprietary model in UK and also Australia. So that is also one of the demand drivers for asset repurposing to get out on this ESG journey to future-proof our real estate portfolio. Next. So we're seeing this slew of REIT listings in Southeast Asia, and in particular in Philippines, we have had 5 listings in under 2 years, with the total capital raised amounting to US 4.3 billion. And with the recent move by the government to amend the rules on REITs, I think developers have been increasingly also looking at listing their portfolio, particularly the income-generating assets. And the REITs will substantially boost the capital markets capability in the Philippines. So new capital for developers will also expand the real estate sector, not only in Metro Manila, but also in other parts of the country, in the provinces. So the successful launch of the REITs bodes well for the property market and also economy as a whole. And this will be a game changer for investors going back to look for assets that are actually more modern and also up to date. Next. So why asset repurposing? So you can see from this table, on the left-hand side, we are really seeing all the advantages of asset repurposing. For example, you can acquire an asset at a discount to the price of the finished products and also reduce competitions from other investors who are only interested in passive strategies. And lower costs versus redevelopment, as a complete redevelopment, tends to incur more significant costs, and keeping the physical structure can actually reduce time to the market and react faster to that new environment. And finally, maximizing values. It can optimize the asset classes to improve your income. And on the right-hand side, you can see there are challenges, of course, because this is not a one-size-fits-all approach to all markets and also to all assets. Because one stumbling block is the government regulations and restrictions with land use and also zoning. But a few countries also have robust incentive schemes for this purpose. And another challenge is also the financial viability, because we know that typically office and retail have higher capital values compared to, say, logistics. So the repurposing to the new economy assets tend to be quite tricky. And lastly, of course, the lack of development expertise, because not all asset owners have the operational capabilities, for instance. Next. So you can see the most cited cases of this asset repurposing is actually involving the conversion of office and also hospitality assets into living sectors such as build to rent or residential projects, and some into business parks and data centers to extract more value. And they can also leverage on the following factors for repurposing. So many times the location of these assets are excellent. As you can see, they pivot to another asset class, such as retail, which tends to be in the city centers, but that's also excellent for last mile logistics, or the inherent design that also can inject some unique characteristics into the new asset. And others can also include the existing facilities and also the underlying catchments for the assets. So maybe let me just give you an example, because I have put up an article on linking on how to repurpose hospitality assets. Next. And you can see that hotels can actually easily be turned into high-rise apartments, for example. So in many cases, hotels tend to locate in the excellent urban centers, which can be attractive to home buyers looking for luxurious living in the heart of the CBD. And also like residential hotels to co-living is also quite ideal, a concept that has been very well received by the millennial population. So the amenities are already there, be it the swimming pool or the dining spaces or the recreational facilities. And hotel to office to co-working is also quite good because it becomes a natural fit when you can leverage on all these meeting room facilities and also the conference functions. And next. So next, I'm going to cover the 5 key drivers for asset repurposing. And the first one next will, of course, be the uncertainties around the occupiers' demand over the medium to long term. This is because occupiers are currently rationalizing or also downsizing their footprints, and they can be moving away from the older assets. So some might be considering repurposing and others repositioning through asset enhancement initiatives. So according to Your Space survey, which is a flagship report published by Knight Frank, we surveyed amongst about 400 global occupiers, and these are the facilities that occupiers actually would like to see in the post-pandemic world. So you can see that facilities that need to support well-beings, such as the sanctuary spaces, or the healthcare stands out, for instance. Next. So the second driver is none other than e-commerce disruption. And it's very, very apparent that we have seen it pre-COVID, but the pace has already quickened, as you can see from this chart. So the proportion of these online sales actually doubled from the pre-COVID level, which is quite remarkable. Even in places like Japan, where online retail is not really the norm, and this trend is pretty much irreversible because it has already been pretty much sticky with the clients, with the consumers. So that's putting a lot of pressure on retail assets for these assets to stay relevant. This is particularly apparent for assets that are not well located or assets that has not a good scale, economy of scale in order to attract the footfalls that retailers actually want. Next. The next driver will be the prolonged weak international tourism that's hitting the hospitality assets. After almost 2 years of being in lockdowns and in limbo, we have not really, come out from these travel curbs. And with this highly transmissible Delta variant, we do foresee international travel taking a while longer to come back. And this Bloomberg survey of 45 large US companies shows that 84% of these companies actually plan to cut down business travel post-pandemic, because virtual meetings are actually expected to replace about 27% of the corporate travel volume. Next. Another driver could be the ESG elements, which I touched on earlier. So it can be both a push and a pull factor, because push in the sense that similar to this chart, the chart we have just shared, demand for older assets and also the non-ESG compliant assets have fallen off the cliff. And from the pull factor perspective, the green value premium based on the active capital research is up to 18% in certain markets, which is a huge incentive for asset owners to consider going green. So we currently don't have a case study on this, but we do see that over the next 5 to 10 years, we're going to witness some of these asset repurposing driven by the ESG attributes. Next. So the fifth driver is really this sector. For the millennials, because there's a lot of interesting development around the structural tailwinds of the sectors that's around logistics, data center, multifamily, and also high specs industrial for life science. So the pandemic really cast a spotlight on these asset classes and making them to the market darlings for, to attract capitals of the future. And that's the result of the digitization journey or the transformation that we're seeing in the real estate space. And I think that is going to be a huge pull factor for asset owners to consider when it comes to repurposing. Next. So we do have this checklist that you can use for self-evaluation. I know a lot of developers, particularly in Philippines, are sitting on a lot of gold mines. I mean, a lot of assets are ripe for maybe for asset enhancement or maybe repurposing. So if you look through the list and you see the answers to most of these questions are yes, perhaps it's a time for you to consider a reposition or a repurposing to tap onto the this journey, because it's going to be beneficial in the next 5 to 10 years. And the next next slide. For the next 2 slides, I'm going to share with you some case studies of what are some of the owners and companies that have done asset repurposing. And I think the first one, although it doesn't happen in Philippines, but it's something that every hotel owner is actually very concerned about. So for this hotel, you can see the hotel owner, they have repositioned this Bismix Yodoyabashi in Osaka to office, because in Japan, unlike a lot of the Western countries, Japan actually had very little disruptions from the work from home trend. So they continue to see this very strong office demand on the back of limited new supply, and that has urged the conversion of the hotel to this office, because they want to quickly catch on the cycle of this office to make sure that because hotel on one hand they have very low occupancy rate, but on the other hand your office demand is still very resilient even during this pandemic. So this is a good analysis of the asset repurposing, and from hotel to office is a natural fit, like what I mentioned just now, because in terms of the capital value, actually office tend to have higher capital value than hotel, and this is especially so during this pandemic. And next. Another case study I would like to highlight is in Singapore. This is the fifth factor which I highlighted on the capturing the structural tailwinds of this pandemic, because you can see that previously this is a retail mall, although we call it the retail warehouse kind of concept, but it's by and large retail mall, just that the footprint is huge. So it's about 1.5 million square feet. I mean, in a small island of Singapore, it's considered pretty big. And they are going to convert it to a business park, which is catered to the TMT sector. That's the telecom, media, and telecommunication, as well as medical, biomedical science, because a lot of these global MNCs are using Singapore as the biomedical hub for Asia, and also the financial institutions, which saw their financial results performing really well because of the high transaction volumes during this pandemic. So they are actually tapping on to the growth sectors and to position away from this retail sector. And the last slide. Yeah. So before I hand over to Ray, I just want to reiterate that this asset repurposing is not just a fad, because over the next 5 to 10 years, I think it really presents a very unique opportunity to asset owners like yourself. So do look out for our research paper on this Knight Frank website. And I hand over to Rick now.
Thank you, Christine, for an excellent synopsis and a very enlightening presentation. which is obviously hugely topical in this market. I know we have a lot of high net worth individuals, developers, and investors that are listening today, and clearly this is clearly one of the most challenging times that we've seen in the last decade, if not in our lifetimes. The same token, this for entrepreneurs, and we have many entrepreneurs out, this is also an incredible opportunity. So thank you for highlighting some of the possibilities, and also backing that up with actually some case studies in terms of what people have been doing to benchmark with. So having said that, before we go to our fireside chat, we have another poll question that will flash on the screen. What types of assets in your portfolio do you feel are due for repurposing? So Christine, if I may, a few questions that basically will relate back to your presentation. So we are now more than a year and a half into the pandemic in Asia. Can you summarize how each of the real estate asset classes have performed since the beginning of the pandemic across the region? And also which markets are seeing green shoots and which ones will take a long time to recover? Thoughts?
Sure. Yeah, indeed, we are almost stuck in this pandemic for 2 years, and it's quite unfortunate that Singapore has just announced the extension of the lockdowns by another month. So we won't be out of the woods until end of November, hopefully. I think things are still evolving given how this Delta variant is causing the resurgence of the infection caseloads, and a lot of the lockdowns across Asia Pacific have also slowed down the economic trajectory. So overall, I would say the office sector is stabilizing, with rental rates declining at their slowest pace at about 0.3% quarter on quarter in Asia Pacific since the start of the pandemic. And some markets have already seen some positive rental growth, such as Singapore and Taiwan. And this is also no surprises here, because really there is this two-tiered market forming for the office sector. You can see the grade A prime office rents are stabilizing in most markets, but the grade B or C markets are actually going down quite substantially, because people are actually moving away from these asset classes. And then for logistics, I think the demand is still very robust, even in the first half of this year, driven pretty much by the e-commerce tailwinds, as more consumers and also businesses continue to pivot online. And we are seeing mostly stable rental growth, and with some markets also registering positive rental growth. For example, in the first tier cities of mainland China, also due to the supply constraint, such as in Hong Kong. So for other parts of Southeast Asia, where cities are still in lockdowns, I think there is some rental in terms of negative reversion, because the consumer spending has been impacted by these lockdowns and pandemic. For residential market, of course, it's another star performer. I think it performed very well during this period. And year on year, we can see from our Knight Frank basket, really the residential prices across the region grow by 6.4%. And this is the highest since Q3 2017. So many markets registered this high pent-up demand due to the lockdowns and also the travel restrictions. I think a few markets that stood out is the Australia market, because they have already seen residential prices going back to their pre-pandemic level, and they have also attracted buyers who are looking for second homes, and also some of the returning expatriates from other parts of the region or other parts of the world. And New Zealand continues to be the hottest market in the region, which even prompted the central bank to increase their interest rates for the first time in 7 years. So really for these asset classes, I think it's still a mixed bag, but in terms of which asset classes bounce back quickly, I would say it is still residential, logistics, and a bit of office. which assets can continue to lag in 2022? It will be hospitality, because even with travel lanes opening up, the region used to receive millions of tourists on the monthly basis, but now it trickles down to thousands. Yeah.
No, so some good advice and some excellent insight there, both on the in terms of reviewing the asset classes and also how they'll be converted. Christine, how long do you expect this great asset repurposing of the decade to continue? And I mean, how long is it going to keep going? What are your expectations for 2022 and beyond? And when do we see the bounce in some of these markets?
Yeah, I think for the asset repurposing, we think that the journey should continue, because this whole journey is, I mean, in terms of the real estate gestation period, is pretty long, five years or so, for an asset to be built from scratch. So we know that this pandemic, we're seeing hospitality assets becoming under pressure, and some hospitality assets have been pivoted to quarantine hotels, or some even to specialized hospitals, while others remain open, although with very low vacancy rates. I think for hospitality assets, there is always a worry of what is going to be the new normal, because business travel is unlikely to return to the pre-pandemic levels. And with the leisure travelers, what exactly is going to be the demand drivers going forward for these business hotels? We think that there's a lot more interest from the asset owners in the hospitality sector to look at repositioning or repurpose these assets. The other asset class, of course, I think is this retail, because it has been disrupted by the surge in e-commerce, and the pandemic basically accelerated the whole trend by 3 to 5 years. So really, in terms of the retail malls, if they have not been on this technology adoption journey, I think it's becoming more and more irrelevant to shoppers. So it can also become a very interesting repositioning in terms of how we look at urban logistics. So really, I think the key is to look at whether we need to make financial sense when we do the asset repurposing. Yeah.
Thank you, and once again, some sage advice. And we have seen a huge amount of interest in new sectors. Obviously, industrial logistics is extremely hot, and we've seen a huge influx of data center clients and whatnot. And the REITs, which have been a long time coming, have now been fully. Basically have, I think that the top 5 have already launched, and we have a number of other ones in the pipeline. So people looking for other ways to raise capital, recycle capital, and obviously, those REITs are going to be accretive. So it should be some more. We should see some more acquisitions as well. Obviously, the big thing is going to be, what are values going to look like, especially if you're seeing office rents under pressure and whatnot. And I think one of the other big things is with the banks, and as well as what's the NPL ratio going to look like in the banks, and will there be banks coming to terms with haircuts, et cetera, as we kind of emerge out of this sort of post, or moving into a post-COVID period. So, but some great dialogue, some great discussion.